Let's go back to the beginning of the session, and that was, of course, job-centric from this morning. Joining us, Guy Berger for the Macro Take. He's Director of Economic Research at Burning Glass Institute. Guy, welcome back to the show. Tell us about your new role, firstly, and what you're focused on at Burning Glass. We spoke to you over the years when you were at LinkedIn, so tell us about the new gig.
Looking at all sorts of interesting labor market trends, from how AI is affecting the workplace to how, the differential impacts of acquiring all sorts of degrees and educational certifications. Lots of interesting work, lots of interesting data.
All right, very cool. So what stands out to you in the data, not just from today, but really if we kind of broaden it out to the last month or so, the main thing that stands out to me is our economic surprise rate is in the basement. It's like the most negative in a year, but it doesn't necessarily mean the information's horrible, right? It's like an expectations game plus a little weakness.
Yeah, the thing that stood out to me first was the unemployment rate went up to 4.1%. Those increases in the unemployment rate have picked up a little bit. And I think nobody wants to see increase in the unemployment rate going up and up. There's all sorts of discussion surrounding the SOM rule and when it's going to be triggered. And that's not great. Payroll growth moderating. Employment, particularly prime working age employment, still holding up pretty well. The quits rate and the JOLTS report's not falling. So it's not a bad economy. But the question is, how much further can it slow before we start getting worried that we're tipping into a downturn?
Okay. And what's going to be the main indicator of that? Is it kind of the moving average of unemployment? Is it job levels? What's to you sort of, your top ranking data point?
I'm looking at the unemployment rate going up. That's one. I'm looking at the share of prime working age Americans age 25 to 54 that have a job. And that's one thing that hasn't worsened. And I think is sort of really, heartening about the recent data. I'm looking at the data from the JOLTS report, like quits and hiring and layoffs, to see if they're moving, and they're, quits are flat. Layoffs don't show a sign of going up. That mix, I think, tells us a lot of what we need to know. And again, in general, it's talking about the labor market cooling. But until all those things start moving in a bad direction in tandem, I'm not worried about us being in a situation like, the late 2000, early 2001, or, the summer, fall 2007, that were just clearly pre-recessionary periods. We're not there yet.
Okay. So the unemployment creep is just kind of something that we naturally sort of expect at this so-called kind of time like this. There still is a general kind of cycle we're going through that adheres to kind of some expectations. You can't stay at really low rates for too long. What about the stuff on the margin where people are having trouble leaving their jobs? Is that starting to get like more imminent of a slowdown?
Well, I think that what's interesting is, I think of very much the quits rate as, one of our best indicators for how people feel about the labor market. You don't quit your job unless you feel like you have a decent chance of finding a new one. That actually came down a lot in 22 and through the beginning of 23, and then really has stopped falling early this year. And my question is, if we're not seeing this declining, how much worse can the environment get from the perspective of job seekers that already have jobs? Now, on the flip side, the one part where you do see a little more weakness is in things like people that are trying to find new jobs. Job postings are falling. We're also seeing that, for example, the unemployment rate for people with, their ages 2024 has been creeping up, particularly if they have a college degree. So these sort of like edges of people that are coming into the labor market, it does seem like they're having more trouble finding a job. And if that intensifies or broadens to other groups, that would be bad. And so to me, it's a question of, how much longer is this cooling going to continue? Is it going to continue to the point where there's serious broad pain in the labor market? Or does it accelerate all of a sudden the way it typically does at the beginning of a downturn? And we're not there, but once it happens, it tends to happen pretty quick. So the idea that there's no risk at all in this kind of situation with monetary policy where it is, I think there's some risk.
Now, we also know that we're in kind of a black hole in terms of like the calendar, because there's no August meeting for the Fed, so the optionality kind of gets reduced. Seems like the market's centering around September for a cut. Then you've also got the election shortly afterwards, where one could kind of debate the impact of that. Could one argue then that there's kind of a window of weakness opening if the Fed's kind of stuck for an extra month than usual?
I mean, look, if the next employment report is terrible, then, I think there's stuff that could happen in the interim before September that would get the Fed to react. But I think that the hurdle there is very high. Instead, what seems more likely is we get some combination of further cooling that's not drastic and doesn't radically change their perspective. We start getting inflation data that's good. And they might think that September is ready to move. And I think the two things that would shift that, again, if all of a sudden the employment data starts deteriorating fast, they'll move sooner. If inflation data is like really cooperative, that really locks in September. I think that the unsettling thing would be if the inflation data is not cooperative and the labor market data also doesn't look great. And then they kind of have a tough choice of what they're going to be doing. That's not a good combination of things to be looking at. Hopefully that doesn't happen. I'm optimistic, but that would be what would be most worrisome heading to that September meeting.
Understood. Hey, we only got about 60 seconds, Guy, but come back to one point that you wrote about very recently, which is immigration. Can you give me kind of the shorthand on what role that's playing in the unemployment creep higher, and how, if there's any change to immigration, what that means for the labor market?
I mean, it's boosting the amount of slack in the labor market, even though it's not. Native-born workers aren't really affected that much. Their employment's as high as it's been since 2007, but immigration's pushing up the amount of job search going on. It's sort of helping to cool the labor market. And it's also helping to generate those relatively strong payroll numbers we've seen over the past year. So it's a funny mix of data we're not used to.
Love it. Guy, great to catch up. Thanks for being here. Always like the analysis, and we'll be in touch. Guy Berger, Director of Economic Research at Burning Glass Institute.